So you've decided you want a new car. Your earnest sales consultant asks you, are you open to the idea of a lease? Leasing, you say. You're just throwing money away. It's like you're renting a car. You never own anything. You aren't building any equity. You have nothing at the end of your lease. You're a slave to your odometer. You can't take your car on trips. There's huge fees if you go over your mileage. Good luck if you ever get into an accident. And as I understand it, you need a lot of money down. What a horrible way of getting a car. No, I'm going to stop you right there. Not interested. That was me about 4 years ago. I'd heard about leasing, and I had the impression that it was just the worst, most short-sighted financial decision you could make. Then, when I started in the car business, I saw that a solid 80% of my coworkers leased their cars. And I thought, well, these are people who do this professionally. What do they see in leasing that I don't? Now that I've been in the car business a few years, and have now had multiple leases myself, I realized that I actually had a bunch of misconceptions about leasing, many of which were based on outdated practices the industry has since changed. Working in the car business, I run into those same misunderstandings from my customers every day. That's why I'm making this video, to explain leasing a little better so we can all make more educated decisions about it. Before we can fully understand leasing, we've got to first look at how many people conventionally finance cars today so that we can have a point of comparison. Let's say that you've done the research and decided to purchase a brand new Funday Opula for yourself. You love it because of its great gas mileage, good looks, and easy maneuverability. After your test drive, the dealership presents you financing options for 60 months, 72 months, and 84 months. The longer the term, the lower the monthly payment. As you look over your payment options, your sales consultant informs you that as these are simple interest loans with no prepayment penalties, you could take the 84-month term to get your minimum payments lower, but you could still make extra payments when possible so as to pay it off early. This idea appeals to you because you want the lowest possible payment for now, and you figure maybe after you get your next raise, future you can afford throwing some extra money at it to pay it down early. You don't want to exhaust your savings either, so you don't put any money down and take the 84-month term. Then you drive your new car home and begin to make your payments each month. And as you do so, the balance on the loan reduces according to an amortization schedule like so. At this point, one of two things will happen. If you end up in the 10% of new car buyers who make it all the way to their final payment on their vehicle, your payments will stop, and the bank will mail you a title. Congratulations, it's yours. You finally own it. If you didn't end up paying extra towards principal, your 84 payments of $436 will have covered the full $30,000 price of the car and around $6,600 worth of interest to the bank. 3 years in, your warranty will have expired, so for the last 4 years, you'll be on the hook for an industry average of around $2,500 for various repairs and around $1,400 to replace common wear and tear items like tires, brakes, filters, and windshield wipers. Altogether, your total out-of-pocket cost for your Opula over the 7 years will be around $40,500. If you decide at this time to trade the vehicle in, Kelley Blue Book estimates you'll get between $3,000 and $6,000 back, depending on mileage and condition. Or you can keep the now 7-year-old car, simply paying the continuing maintenance and repair costs as they arise. If you're more like the other 90% of new car buyers, at some point before you've finished paying off your Funday, you'll start thinking about trading it in. 3 years in, you might say, you know what? I've liked the Opula, but it's just not a great fit for my needs anymore. Gas prices have dropped and my family has grown substantially. I could use an SUV with some room in it, and I really like the looks of that new Aggresso Demander with all the tech and safety features. Maybe I should trade it in. 3 years in, what is your Opula worth? Well, you aren't really sure. So you browse to Kelley Blue Book and Black Book and NADA and get 3 different values online. Then you go to 3 different dealers and get 3 more different values on your 3-year-old Opula. Looking at your payoff, however, no matter who you talk to, the result is the same. Your vehicle is worth less than you owe on it. This is called negative equity, and it happens because vehicles depreciate faster than we pay them off. This chart depicts the typical depreciation of a $30,000 vehicle being driven an average of 12,000 miles a year. You can see that the vehicle takes the largest hit of depreciation when you first drive it off the lot, and then gradually decreases over time. This is what it looks like with an average of 15,000 miles a year. This is what your 84-month term looks like against that. For comparison, here's a 72-month, here's a 60. Anytime the balance on your loan is above the depreciation line, you have negative equity. Anytime the balance is below the depreciation line, you have positive equity. The shorter term you take, the sooner you'll break even and begin to accrue equity because of the higher payments. But again, with your Opula, you wanted the lowest possible payments, so you took out the 84-month term. That means 3 years in, you still owe up here. Unless you actually become the mysteriously wealthy future you and start making higher payments, it'll be over 5 years before you even come close to breaking even. Now at this point, you still want that new Aggresso, because the Opula just doesn't work for you anymore. So, you bite the bullet, buy the Demander, and roll your negative equity into another loan, taking another extended term once again so that you can still afford the payments, which are now $70 a month higher than they would have been because of your negative equity. That puts your ability to buy another car even further out. And then you're trapped. If you decide 3 or 4 years later that the Demander doesn't work for you anymore, you owe so much more than it's worth that you can't get out without a large down payment or a significant increase in monthly payment. So you're stuck paying on and driving a vehicle you don't like. At that pace, you won't break even until almost 6 years in. Now, a lot of this could have been prevented if you would have just taken a shorter-term loan with higher payments or put money down when you financed. But the data doesn't suggest people are doing that. In 2017, there were over 110 million active car loans in America, totaling $1.129 trillion. The average term length on new loans was 69 months, with only 17% of loans being for 60 months or less. Even with this tendency towards long terms, the average car payment was still over $500 a month. Americans are struggling against their negative equity, and the problems are getting worse. New cars are getting more and more expensive, and we keep taking longer and longer loans out on them to get affordable payments. Then we either keep our cars until they're not worth anything, paying huge amounts in interest and repairs, or we trade them in with negative equity, thus compounding the problem. What if there was a better way, where we could get all the benefits of driving a new car, still have low monthly payments, but avoid all the hidden costs of interest, maintenance, repairs, and negative equity that come along with taking out an extended term loan? This is the question leasing seeks to answer. Unlike a traditional finance, where you take out a loan on the whole price of a vehicle, and then have no idea what it will be worth 2 to 4 years in, with a lease, the manufacturer actually tells you, based on the amount of time you expect to keep your vehicle and the number of miles you expect to put on it during that period, an exact amount your vehicle will be worth to them at that time as a trade-in. That is calculated as a percentage of the MSRP, and is a guaranteed, set-in-stone, doesn't-change value called a residual. The fewer miles you drive, or the less time you plan on keeping the vehicle, the higher the residual will be. The more miles you drive, or the longer you plan on keeping the vehicle, the lower it will be. Then, instead of taking out a 60 or 72 or 84-month commitment against the whole price of the vehicle, the manufacturer only asks that you finance the difference between the sales price and the residual over that period you expect to keep it. The most common leases are between 24 and 48-month terms, and the most commonly declared mileage allowances are between 10,000 and 20,000 miles per year. Whatever combination you declare upfront determines where the residual is set, and what portion of the car you then agree to finance. Then, just like with a conventional finance, you drive your new car home and begin to make payments. And just like with the conventional finance, as you make those payments each month, the balance against the car decreases. Going back to our example of the Funday Opula, the dealer tells you that Funday is doing a good program on their 36-month lease, and asks you how many miles you plan on driving during that time. You think you'll do around 12,000 miles per year, so with no money down, the monthly payment comes out to only $362 a month for 36 months, with a residual value of $17,157. Taking a look at our graph, it kind of looks like this. Then, what happens here? Well, this is the cool part, because at the end of those 3 years, you will have paid off your predetermined portion of the vehicle, or in this case, around 48% of it. At that time, you will be given 3 options for what you would like to do with the remaining amount. Option 1. Let's say you've decided you no longer want the Opula, or you'd like to get something else. In that case, you can return the vehicle back to the manufacturer, and they will pay off the remaining balance completely. This means that while you technically still owe the full amount of the residual, the manufacturer has already agreed to buy it back from you for that exact amount, regardless of how much the vehicle may have actually depreciated at that time. This gives you the freedom to drop your car off and get something else, with no negative equity. You could lease or buy another Opula. You could get an Aggresso. You could buy a bicycle. Your commitment on the lease is over. So option 1 is to turn in the vehicle, and the remaining balance is paid off. Option 2. Let's say you end up loving the Opula, and at the end of your lease, you aren't ready to give it up just yet. In that case, you've already paid for 48% of it, so that remaining 52% residual portion is considered the balance remaining on the vehicle. If you would like to, instead of giving it back to the manufacturer, you can keep making payments against that balance, turning it into a conventional finance at that time. You'll have your choice of terms and financing options too, so you can decide what happens to your payments as well. It's just like financing a used car, but you know the previous owner. So option 2 is to buy out your lease and keep driving it. Option 3. How did the manufacturer come up with that residual? Well, it was an educated guess. Nobody has a crystal ball. Nobody can know exactly what the real market value of a vehicle will be 3 years down the road. If you declared you were going to put 45,000 miles on the car, but then got a job closer to home and only ended up driving 15,000 miles, well, there's a good chance that at the end of your lease, the vehicle might be more valuable than the manufacturer anticipated. In this case, if the vehicle appraises at a higher value than the residual, instead of giving the vehicle back to the manufacturer, you could sell the vehicle or trade it into a dealership. The remaining balance of the residual gets paid off, and any equity above that can be used as a down payment for your next vehicle or as cash back to you. So option 3 is to sell or trade in your lease. Getting back to your Opula, if you had decided to lease instead of taking an 84-month term, your payment would actually be about $80 a month less for those first 3 years. At the end of your lease, if you still wanted the Opula, you could finance the remaining balance at a 48-month term with no money down for around the same payment. Or if you decided to put that extra $80 a month of savings into a car fund, you might consider using the $2,800 you saved over the 3 years as a down payment towards financing the residual for 36 months, so you could pay it off more quickly. Alternatively, if at the 3-year mark, you look over your needs and decide, actually, I do want an Aggresso Demander. Regardless of how much the Funday actually depreciated, you don't have any negative equity, because you can turn the vehicle in and the residual balance is satisfied. At that point, you'd hand the keys back to Funday, no negative equity, walk into an Aggresso dealership, and buy or lease a new demander any way you choose. Doing the math, during the first 3 years you will have made 36 payments of $362, or about $13,000. At the end of the lease, if you turn the vehicle in and re-lease for another 3 years, you'll spend another $13,000 or so to drive the next one. You've never had to buy tires, or replace brakes, or do any kind of repairs to either vehicle, because they've both been brand new vehicles under complete warranty the whole time. So all you've spent to drive 2 brand new vehicles is the total of your monthly payments, or $26,000 over 6 years. Then, you still have the opportunity to buy out the next one for the residual, or lease a third time should you so choose. And that's really what leasing is all about, giving people lower payments so they can drive the newest, most advanced, and safest cars with fewer out-of-pocket expenses, and the ability to trade out more easily should their needs or tastes change. Now that said, I don't like to give one half of the story without addressing the other half. This all sounds rosy and great, but what's the catch? What happens if you go over your mileage? What happens if you damage the vehicle? What about money down? Well, let's address each of those. What happens if you go over your mileage? The only time mileage matters with a lease is at the very end if you choose to turn in the vehicle to the manufacturer. They set the residual based on the mileage you told them the vehicle would have on it at the end of the lease. If you give them back the vehicle over that mileage, they'll charge a fee of around 20 cents per mile as an adjustment. You can do the math. This is why it's important to declare an accurate estimate before you take the lease, so they can adjust the residual and payments accordingly ahead of time. It's usually cheaper to buy more miles up front and not use them than it is to pay for them after the fact. That said, if you are going to be over, you'll know that fee is coming well before you end your lease, because you look at your odometer every time you get in the car and can budget accordingly. You can also call your local dealer to see if there's any pull-ahead programs available, so you can end the lease early before you reach your mileage allowance, thus avoiding any fees. Again, if you buy your lease out, or trade it in, or sell it, you can basically stop worrying about the mileage because none of the above applies. What happens if you damage the vehicle? Again, just like with mileage, the only time damage matters is if you choose to turn in the vehicle with the manufacturer. At the time of turn-in, there will be a third-party assessment of wear and condition. In the case of normal wear and tear, a few dings, dents, and scratches here and there are acceptable, and will not carry any kind of penalties. In the case of a major accident, and just like if you'd financed, you're going to have your insurance company fix the damage. As long as you do so before turn-in, there is no penalty. If the vehicle becomes totaled, most leases have built-in gap coverage, meaning the entirety of your lease will be paid off regardless of what your insurance company says it's worth. No penalties there either. The only time you'll be charged any kind of fees for damage are for the medium damages that require significant reconditioning. Things like cracked windshields, tears in the upholstery, or major paint damage. If you turn the car in with this kind of excessive wear, the manufacturer will assess a fee for their reconditioning expense. If you're worried about this, it's worth noting that most lease companies sell excessive wear and tear insurance that covers potential reconditioning fees. I highly recommend this with any lease, as it's usually only $20 a month or so on top of your lease payment, but covers in some cases up to $10,000 worth of damage, so you're not on the hook in case something does happen. Again, if you buy out your lease or trade it in, there is no assessment and no risk of fees. Finally, regarding money down, while a lot of the advertisements you'll see on TV make it seem like you need an exorbitant down payment to lease, most of those are only showing that so they can advertise an extremely low lease payment on a pricey vehicle. Every $1,000 that you put down reduces the payment on a lease by around $28 per month. So all $5,000 down gets you is about $140 lower in payment. In most cases, all that's due at signing is your first month's payment. So that about wraps things up. I hope that now you have a little better idea about how leasing works and why you might choose it over a conventional finance. While I chose to use fictional brands for my examples, all the numbers I used and principles I discussed are legitimate and representative of many brands' real-world programs today. I intentionally left a few things out that are largely dependent on which manufacturer you're trying to lease from. So, just like with anything, before you lease, you need to investigate the specifics of the programs you're looking at. But for the most part, everything I mentioned in this video will apply. Finally, it almost goes without saying, but it's impossible to guess what the lease payments will be on any given vehicle just by looking at the price. I sell $20,000 vehicles that have higher lease payments than $40,000 vehicles simply because of the sheer number of variables that affect a lease payment other than MSRP. Your local dealer will be happy to help point you in the right direction when it comes to choosing the best lease programs for your needs and budget, or go over the specific terms and policies of their leasing programs if you need more help. So that's all I've got. My hope is that after watching this video, the next time you decide you want a new car and your earnest sales consultant asks you, "Are you open to the idea of a lease?" you'll say, "Leasing? I'll consider it." Thanks for watching. If you liked this video, click that like button. If you loved it, go ahead and subscribe. I'll be hanging out in the comments below to answer any questions that I wasn't able to cover in the video. Until next time.